So how do you look at the, what the Fed's done? Are we restrictive or not? And the impact on the economy of Fed policy?
Yeah, I think if you look at this question of uh, are interest rate hikes or the current level of interest rates, very restrictive or not restrictive, that's an empirical question. That's not a theoretical question. I think there's a lot of people who get sort of wrapped up in what is R star and what is neutral and theoretical reasons why it should be one level or another. And I think for people who trade markets in the day to day, like who cares what some theoretical R star is? Like what you care about is, are interest rates high enough to slow the economy or not? And I think when you look at that question, um, the the it's not like interest rates have had no effect on the economy. They certainly have had some effect, particularly for those borrowers who are who need incremental borrowing to sustain themselves, have faced much painfully higher interest rates. And so the most liquidity sensitive sectors have experienced a significant tightening as a function of that. And so you see like the most sensitive liquidity sensitive sectors like venture capital, loss making enterprises like that. A lot of them have failed, are failing, prices have fallen a lot, et cetera. The issue is at an economy wide level, those sectors are just like are not that sensitive, are not that big a deal relative to the overall economy. Most of the overall economy is cash flow positive, whether you're talking about businesses or households. They're cash flow positive, they're not borrowing a lot of money. And so therefore, it's not that the interest rates have had no effect. They just haven't had that much of an effect and certainly haven't been able to overwhelm the income growth effect, both for households as well as for corporations over the course of the last couple of years. And so you're seeing a slower economy than would otherwise occur if those rates hadn't risen, but not one that is, certainly not very restrictive. Like I think this idea, I almost have to chuckle every time someone talks about very restrictive monetary policy. Like, let me tell you a story about very restrictive monetary policy. Like, very restrictive monetary policy means stocks are going down, credit spreads are going up, the economy is slowing rapidly. Like, where in the world is very restrictive monetary policy? Credit spreads are at lows, stocks are at highs, the economy's grown at 2 to 3% real for the last 8 quarters. Like, what on earth do you look at to say this is very restrictive monetary policy, except theory, some theoretical notion of R star?
Yeah, I mean, some people are pointing to things like weakness in the manufacturing sector. The PMIs are weak. They're pointing to jump in the unemployment rate recently, where it broke. It moved above the so-called SARM rule. People look at the performance of stocks outside of the Magnificent Seven, which has been relatively weak. So because of all of those things, people have started to talk a lot more about, okay, there is something happening here. We are about to hit a recession.
Well, there's a big difference between a late cycle moderation as a function of tighter monetary policy and the idea that monetary policy is very restrictive and we're falling fast into a recession, right? Those two things are they're just very different stories. Like, and I think what's coloring people's view of this sort of dynamic is the credit driven cycles, because it's true, credit driven cycles are acute on the downside because they're self reinforcing on the downside, which is typically a very high borrowing. And then that starts to slow, which deteriorates asset prices and incomes and balance sheets. And that creates further deleveraging and further deleveraging. But that's not what's going on here. What's going on here is a very, very gradual slowing of economic conditions. It's true. Yeah. The unemployment rate's up, 70 basis points over the course of the last year, but it was at 3.5%, 3.4%. It's not like we're talking about something that is like a disaster here. We're talking about a very gradual slowing, not to mention the fact the unemployment rate is the weakest, essentially, of all of the labor market indicators. Or let's talk about manufacturing. Capacity utilization is at it's at the 25-year average. So it's moderated a little bit, but we're not talking about, you want to talk about a recession, we're not close to a recession here in terms of the manufacturing sector. And so I think people are trying, it paid for a long time to try and get ahead of the immediate downturn type dynamic, um, particularly when you were talking about credit driven cycles. So once there was some moderation, it was self reinforcing to the downside. And that's created a trained behavior where people think that just because I see some weakness somewhere means that we're going to collapse, the economy is going to collapse. And look, what have we learned over the course of the last 3 years, which is that um, a weakness in one area or some signs of softening are not good predictors of the path of the overall economy and monetary policy. And I think we're seeing the same thing largely play out again today.